The Renaissance and modern day Dirty 30. You're living through one of the most pivotal times in the financial markets today. I'm not talking about the volatility, nor am I talking about crashes. Influencers and the madness of crowds can move mountains of paper of stocks that were previously thought to be extinct. AMC is a perfect example. And today, the voice of the shareholders matters now more than ever. Like I wrote previously, Exxon is a perfect example. One of the world's largest oil producers had its board of directors defeated by a small but outspoken fund. And this example is just the tip of the iceberg. It's just a matter of time before the US SEC, the Securities Exchange Commission, mandates all publicly listed corporations to disclose their carbon emissions like they do with their financials. On July 28th, 2021, the new SEC Chairman Gary Gensler expressed his views on the subject. I'm sure many of you didn't even notice, but I did. And you should know what impact such a move would have on the financials of all publicly listed companies. Coming soon, mandatory emissions reporting. The next step is for corporate valuations to include the cost of carbon emission reduction and offsets in their valuation models. This will be the basis for all ESG investing in green bond participation. Probably the most clever moment in my career was being the first in the finance industry to incorporate the cost of carbon offsets and carbon footprint reduction costs into project and corporate valuations in the NAV, net asset value, and the IRR, internal rate of return models in 2019. I was initially mocked by the brokers and analysts at brokerage firms. Remember, they're called brokers for a reason because they'll make you just a little bit more broker after you do business with them. In the next few years, expect major financial valuation write-downs across the board. Subscribers to Katusa's Resource Opportunities, which I call the KRO, know we're ahead of the curve on this and have already created our list of companies that we will avoid for that reason. So, who are some of the names to keep an eye on? Let's get to it. Market size. Breaking down the Dirty 30. Currently, 33% or 1/3 of global carbon emissions are created by 30 corporations. You heard that right. 30 corporations emit 1/3 of all global carbon emissions. And here's the chart. You're looking at it right here. I did the homework for you guys. But let's break down the list between positive and negative swapline nations. We have to incorporate political risk in all of our analysis. The positive swapline nation, Big Dirty 30, CO2 emissions list includes 14 corporations that make up about 10% of global CO2 equivalent emissions. Here's the chart. These are the positive swapline nations of the Dirty 30 members. Makes up about 10%. A very important aspect of the list you're looking at right now is that of the 14 companies, only Pemex is a state-owned, meaning no shareholders other than the state. The other 13 have shareholders. The 13 of the 14 of the positive swapline nations that make up 10% of the global carbon emissions are publicly listed, which means shareholder votes matter more now than ever before. Those votes have been cast, and the management and board have been directed to lower emissions. Like engine number one, the small little fund in Exxon is a perfect example of what happened. The negative swapline nation Big Dirty 30 members include 16 corporations that make up just under 23% of the global greenhouse gas emissions. Here's the chart that I put together for you. Only 14 of the 16 negative swapline nations of the Big Dirty 30 are owned by shareholders. The other 12 are state-owned, meaning only the government owns it. Just over half of the world's Dirty 30 are public. Those companies are the ones that will face public scrutiny and shareholder revolts if they don't clean up their act. Literally. Relying on technology that'll get invented 30 years from now doesn't solve the immediate problem. For corporations, both a short-term and a long-term approach to decarbonization is necessary. Carbon offsets provide an immediate emissions abatement, which sets a path forward for the company. In fact, I'd say they're mission critical to many publicly traded companies today, especially those in hard abate sectors, meaning the dirty polluters. Even if we assume only 50% of the companies on the positive swapline nations commit to reducing their emissions by 50% by 2035, that alone makes up over a tenfold increase in carbon offset demand in the voluntary carbon market. Pay attention. Let's take this a step further because the math matters. In the steel, cement, and oil industries, 24% of all CO2 equivalent emissions globally are controlled by shareholders like you and me. That group currently emits over 12 billion tons of CO2 emissions annually. What you're looking at right now is a pie chart that we put together for you of the 2018 CO2e, that's carbon dioxide equivalent emissions breakdown by ownership. And this is just focused on the steel, cement, and oil industries. The black section, which makes up 38%, is the nation state emissions. The green is the investor-owned, which make up about 24%. And the state-owned enterprises making up 38% in red. Reductions are coming in a big way. Whether you personally agree with the change or not is irrelevant. Keep your ego out of this. It's coming. In fact, it's already here. So prepare yourself accordingly. Grenium, the green premium. Investors around the world are rewarding companies with a Grenium. Grenium is the combination of a higher share prices and lower cost of debt. These Greniums will be magnified in heavily polluting industries. So we put together a chart that shows the average coupon payment made by companies in the dirty sectors, meaning oil, steel, and cement. You'll see that today, those companies pay a much higher coupon rate for debt. However, because green and sustainability-linked bonds are issued at lower coupons, meaning lower interest rates, these heavy emitters can reap these cost of savings by going green and reducing their carbon footprint. Lower price debt improves the company's income statement and should result in improved valuations, leading to higher share prices for shareholders like you and me. So look at this right here. This is the average bond coupon rate globally. In the far left column, you're looking at that green bar. That's the ESG global debt. It's about 1 3/4 on average percent. The non-ESG in Europe is about 2.5. The non-ESG North America is over 4.5%. Now, the net zero steel, cement, oil sector is just under 4%. And you're looking at the global steel, cement, oil is touching 6%. As steel, cement, oil transitions towards net zero, bond coupon rates will decrease by over 1/3. That is significant improvement to the balance sheet and the cost of servicing the debt. You can see that globally. ESG debt issues significantly lower coupon rates. I'm not saying that all dirty debt will become completely ESG friendly. It simply won't happen. I'm simply saying that it's reasonable to expect a 2 to 3% decrease in coupon rates, that's the cost of the money, the interest rate, for dirty companies going net zero. And this would still be well above the average coupon rate of regular non-ESG debt. I hope management teams are paying attention to this. This decrease in interest payments equates to $120 billion a year in cost savings for just oil, steel, and cement companies annually. Just based off of these savings alone, this has the potential to add over $1 trillion in market cap to the sector, just the specific steel, cement, and oil sector over the coming decade. Here they have heavy emitters. That's the steel, cement, and oil industries that we put together. This is game changer stuff. I hope you're paying attention. So let's bring in a real case study here. This is the $800 million real-time case study. Recently, the government of Canada announced that it's putting up $400 million of taxpayer money to help the world's largest steel producer, ArcelorMittal, switch its steel-making facilities from blast oxygen furnaces to electric arc furnaces. Through switching to electric arc furnaces, ArcelorMittal believes it can reduce its emissions by 62.5%. But this is the second foray into financing emissions reductions by the Canadian government. The Canadian government also awarded $420 million to Algoma Steel to convert to electric arc furnaces. Now let's assume every government in the world will be as generous as Canada's and financially contribute to the steel sector's emission reductions. Globally, the steel industry emits 8% of all carbon dioxide emissions, which equals to about 2.88 billion tons of CO2 annually. Assuming everyone converts to electric arc furnaces, steel-related CO2 emissions will fall by almost 1.8 billion tons from the 2.88 billion tons, implying an annual emittance of 1.1 billion tons of CO2. To get to net zero, the steel sector would still need to offset 1.1 billion tons of CO2. What does that mean? This means that the voluntary carbon market, the VCM, would need to grow by nearly 5 times just to cover those residual steel emissions after all steel production goes to electric arc furnaces. Think about that. Below is a chart which shows the progression from today's emission levels to reduction through conversion to electric arc furnaces just for the steel industry and the final requirement to go net zero. That's how big this opportunity is. This is just the steel sector after billions upon billions of government subsidies. The takeaway here is this: even if the government gets massively behind all the heavy emitting industries to help them transition, enormous amounts of carbon credits and offsets will still be required. If you think the climate change is bullshit, that's totally fine. Believe whatever you want. But don't get left behind when the carbon markets take off without you. You've been warned. Stay safe. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.